Oracle is preparing another round of job cuts in 2026, with some teams facing reductions in the double digits, according to a Business Insider report published on August 11th. Managers have been told to compile lists of affected employees before the company's second fiscal quarter begins on September 1st. The new round would extend a year of deep cuts at the company, which shed 21,000 full-time positions, or 13% of its workforce, in the fiscal year that ended May 31st. That brought headcount down to approximately 141,000 employees from about 162,000 a year earlier. Oracle attributed part of the decline to internal AI adoption and told investors that further reductions would follow as deployment grows. The company's own filing states that the adoption and deployment of AI technologies across operations have resulted, and may continue to result, in reductions to the workforce. That kind of language rarely appears so directly in corporate disclosures, but Oracle has been unusually explicit about the connection between its AI ambitions and its headcount decisions. The urgency behind the cuts becomes clear when you look at the numbers. Oracle's capital expenditures jumped to $55.7 billion in fiscal 2026, up from $21.2 billion the year before and just $6.9 billion 2 years earlier. The company's spending outpaced cash generation by $23.7 billion. To cover that gap, Oracle raised $43 billion in long-term debt during the year and issued $5 billion in preferred stock. Long-term debt on Oracle's balance sheet climbed to $122.3 billion as of May, up from $85.3 billion the prior year. The company expects to raise roughly $40 billion more through a mix of debt and equity in the current fiscal year. Interest expense climbed to $4.6 billion from $3.6 billion a year earlier. The annual growth in Oracle's interest bill alone now exceeds half of what it paid in severance and related restructuring charges all year. The company recorded $1.8 billion in restructuring expenses in fiscal 2026, a 391% increase over the $374 million booked a year earlier. Its 2026 restructuring plan has an estimated total cost of up to $2.1 billion, leaving roughly $300 million of headroom under the existing plan. Cuts at the scale Business Insider describes would either need to fit inside that remainder or push Oracle into its second new restructuring plan in 3 years. The tension between AI demand and the cost of building the infrastructure to serve it has become a wider issue for large technology companies. A July Reuters analysis found that capital expenditure by major U.S. technology companies was rising faster than their free cash flow as they invested heavily in data centers, servers, and other AI infrastructure. Oracle was among the companies highlighted in that analysis. The company's cloud infrastructure business grew 77% last year, and total revenue rose 17%. In the fourth quarter alone, cloud infrastructure revenue jumped 93% to $5.8 billion. Those are strong numbers for a decades-old database software company. But revenue growth is not enough to cover the cost of building out AI data centers. Cutting payroll is one of the few levers Oracle can pull quickly enough to help offset a growing data center bill. During Oracle's May round of layoffs, Barclays argued in a note that the layoffs function mainly as cost discipline the market already expects. The firm has maintained an overweight rating on the stock throughout the year. Oracle's stock surged more than 5% following the most recent layoff report. However, valued at a market cap of $441 billion, the stock is still down 56% below all-time highs. Between June 2nd and July 2nd, the stock fell 42.7%, wiping out roughly $265 billion in market capitalization. The centerpiece of Oracle's AI strategy is the Stargate Initiative, a $300 billion contract with OpenAI running from 2027 through 2032. The company is betting that aggressive workforce cuts and massive borrowing can bridge the gap between building the infrastructure and earning from it. But the borrowing has triggered a legal challenge. The Ohio Carpenters pension plan filed a securities fraud lawsuit alleging that when Oracle offered $18 billion in bonds, the offering document stated the company may need to borrow more, despite allegedly having already planned a $38 billion loan package. Shareholders sued the company in January over statements about how much it would need to borrow to meet its $300 billion OpenAI commitment. The company's stock is down more than 20% this year. Oracle is not alone in this pattern. Across the technology sector, companies are cutting jobs while investing heavily in AI. Global technology companies have cut nearly 154,000 jobs in the first half of 2026. Meta has cut around 10,400 positions. Microsoft, Google, Amazon, and others have continued restructuring around AI. Intuit joined the wave with 3,000 job cuts tied to its AI strategy. Mondaycom became the latest tech company to cite AI as a factor in job cuts. The running list of major tech layoffs in 2026, where employers cited AI, includes GitLab, Cisco, Coinbase, Microsoft, Snap, and Meta. The trend extends beyond individual company announcements. Artificial intelligence has become the leading reason cited by employers for job cuts in the United States. According to data from Challenger, Gray, and Christmas, AI-linked layoffs reached 87,714 in the first 5 months of 2026, surpassing the combined total recorded in 2024 and 2025. By comparison, companies cited AI as the reason for 54,836 layoffs during 2025 and 12,742 during 2024 combined. U.S. employers announced more than 97,000 job cuts in May, the highest total for the month since the onset of the COVID-19 pandemic in 2020. Layoffs have risen for 3 consecutive months, increasing from 48,307 in February to 60,620 in March, 83,387 in April, and over 97,000 in May. According to the report, artificial intelligence accounted for nearly 40% of all announced job cuts in May, up sharply from 7% in January. The share of AI-related layoffs increased steadily through the year, reaching 10% in February, 25% in March, and 26% in April, before surging further in May. In May alone, employers attributed 38,579 job cuts to automation, the highest monthly figure since Challenger began tracking AI-related layoffs in 2023. Andy Challenger, Chief Revenue Officer at Challenger, Gray, and Christmas, said AI is now the leading reason companies give for cutting jobs. The technology sector accounted for the largest share of workforce reductions. U.S. technology companies announced 38,242 job cuts in May, the highest monthly total since August 2024. On a year-to-date basis, technology sector layoffs have climbed 66%, making it the hardest-hit industry. Job cuts in technology are now running at nearly 3 times the level of the next most affected sector. Despite the sharp rise in AI-related layoff announcements, several economists and labor market researchers have cautioned against attributing all job losses directly to automation. Daniel Kiem, associate professor of management at Columbia Business School, noted that the broader U.S. labor market remains relatively resilient. U.S. payrolls increased by 172,000 in May, while employment data for March and April were revised upwards, according to figures from the Bureau of Labor Statistics. Kiem argued that AI's impact remains concentrated in specific industries, particularly technology, rather than across the wider economy. Daniel Zhao, chief economist at Glassdoor, cautioned against taking companies' assertions about AI-related layoffs at face value. A company can say AI is why it is doing layoffs, but that does not necessarily mean that is actually why those layoffs are happening. Some companies may be scapegoating AI to justify layoffs. Fabian Stephanie, assistant professor of AI and work at the Oxford Internet Institute, expressed skepticism about some AI-related claims. He said he is really skeptical whether the layoffs that we see currently are really due to true efficiency gains. It is rather a projection into AI, a way to use AI to make good excuses. At the same time, there are definitely a lot of companies that are changing how they are allocating resources in response to AI. That could mean that a company cuts jobs in certain areas while hiring in others. The distinction matters because the official labor data tells a more complicated story than the layoff announcements alone suggest. The U.S. unemployment rate is low at 4.1%. Initial jobless claims rose to 209,000 in the week ended August 8th, above expectations, but layoffs remain at historically healthy levels. The number of people continuing to receive unemployment benefits fell to 1.78 million. The labor market is in much better balance than during the peak of the pandemic inflation, and there are no longer more job openings than unemployed workers. Hiring activity, however, continues to lag historical levels. Employers announced 80,742 planned hires in May, which Challenger described as weak compared with pre-pandemic norms. The pressure is beginning to appear in entry-level hiring. Where past waves of automation swept through factory floors and manual work, AI is now hitting white-collar jobs, especially entry-level ones. In the first quarter of 2026, tech companies laid off more than 78,000 workers, with 48% attributed to AI automation. Anthropic CEO Dario Amodei has warned that rapid advances in AI could trigger a serious employment crisis by replacing large numbers of entry-level white-collar jobs across industries. He has predicted that AI could eliminate half of all entry-level white-collar jobs and push unemployment to 10 to 20% within 1 to 5 years. The Oracle case illustrates a broader shift in how technology companies are allocating talent. As companies invest more heavily in AI infrastructure, they are simultaneously looking to control costs and restructure roles affected by automation and AI adoption. This can reduce demand for some existing positions while increasing demand for specialized capabilities in areas such as AI, cloud infrastructure, data centers, and advanced computing. Technology companies may be creating new opportunities around AI while reducing or redesigning roles that are becoming less critical to their operating models. For employees, this makes skills adaptability and AI readiness increasingly important. The development also puts pressure on employers and HR leaders to manage the workforce transition alongside AI investment, balancing productivity gains and cost efficiencies with reskilling, internal mobility, and support for employees whose roles are being redesigned. Goldman Sachs now says AI could displace roughly 15 million American workers over the next decade, or about 9% of the U.S. workforce. That is a significant number, but it is not an immediate collapse. The process will be uneven, and it will depend on how companies choose to deploy the technology. What is happening at Oracle is not simply about one company cutting costs. It is about a broader reorganization of work. The company is spending more than it generates to build AI infrastructure. It is borrowing heavily to fund that spending. It is cutting thousands of jobs to help pay the interest on that borrowing. And it is telling investors that AI adoption will continue to reduce headcount. The revenue from its cloud business is growing rapidly, but not rapidly enough to cover the capital costs. The company is testing whether aggressive workforce cuts and massive borrowing can bridge the gap between building the infrastructure and earning from it. The answer is not yet clear. The stock market has punished the company, bondholders have sued, and employees are bearing the cost in the form of job losses. The pattern is repeating across the technology sector. Companies are investing in AI, restructuring around AI, and using AI as a justification for reducing headcount. Some of those cuts are genuine automation. Some are cost-cutting dressed up in the language of technological transformation. Some are a response to overhiring during the pandemic years. Some are a response to interest rates and investor pressure for efficiency. But the cumulative effect is the same. Fewer positions, higher expectations for those who remain, and a weaker path into stable employment for new entrants. Work is being reorganized. Technology changes what companies are capable of doing. Capital determines what they are willing to spend. Management decides how the technology is deployed. Workers experience the consequences through hiring, wages, workload, job security, and career opportunities. The Oracle case shows that strong AI demand does not necessarily translate into broad-based workforce growth. It can coexist with deep cuts, rising debt, legal challenges, and declining stock prices. The company is spending $55.7 billion on AI infrastructure while cutting 21,000 jobs and planning more. That is not a contradiction. It is a choice. Management has decided that the path to AI-driven growth runs through a smaller workforce. Other companies are making similar calculations. The result is a labor market where hiring remains weak, entry-level opportunities are shrinking, and workers are expected to produce more with less. The unemployment rate remains low for now, but the structure of employment is changing beneath the surface. The jobs that are being created are not necessarily the jobs that are being eliminated. The skills that are valued are not necessarily the skills that were valued 5 years ago. The career ladders that once existed are becoming narrower. The companies that are investing most heavily in the future are also cutting most aggressively in the present. For more videos on AI, work, layoffs, and the changing job market, subscribe to the channel.